We're going to have a chat about the media speculating on property prices and how median values don't really give you an accurate picture of where Australia sits at this point in time. My name's Luke. I talk all things real estate, renovating and financial freedom on the channel. Make sure you subscribe down below. I've been loving seeing people subscribe. Drop a comment. I love chatting and vibing with people in the comments. I reply to most of the comments on the channel. That really helps me out. And let's dive into today's article talking about property prices across Australia's major capital cities. Aussie property prices see the biggest drop in value in almost 40 years. Australian property values have suffered their biggest monthly drop in almost 40 years. CoreLogic's National Home Value Index recorded a fourth straight month of decline in August, with the retreat in prices accelerating and covering more of Australia. The drop in August was 1.6%, the biggest month-to-month decline since 1983. Now, to me, we're coming off historic highs. So even though there's been a median fall of 1.6% across Australia, that doesn't really affect people at the suburb or street level. You've got to look and narrow down and look at your own portfolio and the specific suburbs you're potentially looking to buy to see exactly how this might affect you. At the end of the day, you're only buying that property in a specific street, in a specific suburb. So if you're looking at the median fall across August around 1.6%, or you're looking Australia-wide, this might not be affecting the markets you're invested in or looking to invest in. Every capital city apart from Darwin is now in a housing downturn. Well, that's a big statement. And regional Australia isn't too dissimilar, with only South Australia recording an increase in regional housing values for the month. Sydney continued to lead the downturn as expected, with a fall of 2.3%, but Brisbane also saw an accelerated decline, with values falling 1.8%. CoreLogic's research director Tim Lawless said Brisbane's shift into decline had been acute after almost 2 years of sustained growth due to record high internal migration and relative affordability. And in my opinion, that still stands for Brisbane over the long term. You're not buying the Brisbane market for the next 3 months, for the next 1 month, the next 6 months. You're looking out ideally for a 5, 10, 15-year horizon. And the truth is, Brisbane prices have seen a pullback. 1.8% or 2% for the month isn't noticeable to most people because you're trying to negotiate on a specific property deal. There are opportunities out there in the market at the moment, and what we're finding is instead of there being 20 to 30 people at open homes as there were last year, there's 5 to 10 groups going through properties. So there's more options out there as we come into spring selling season, but it doesn't mean we're seeing much material decline in prices from these historic highs. I'm obviously very bullish on Brisbane over the long term, so take my confirmation bias with a grain of salt, but I think that Brisbane has great fundamentals for long-term growth, and that relative affordability is going to continue to be there, and people both interstate and from overseas will want to continue to move into the Brisbane market. So let's take a look at the numbers that CoreLogic released for August period. So this is the index results as at the 31st of August, and you can see across the board that there have been some monthly declines. So 1.8% for Brisbane, Adelaide pretty steady, Perth pretty steady, Hobart down a similar amount to Brizzy at 1.7%, and Sydney leading the charge at a 2.3% fall. An average of 1.6% nationally and down 3.4% for the quarter, largely led by Sydney and Melbourne. The real interesting thing here is that the annual and the total returns are still significantly up across most of the major capital cities, except for Sydney and Melbourne, with Brisbane and Adelaide around the 21 to 25% mark, Perth and Hobart having still 10% growth in their returns, and Darwin and Canberra around that 12% mark. So we're coming off historic highs. The property market can't run away forever. So we're always going to expect these dips, these increases and these ups and downs over time. Let's read on here. It was only 2 months ago that the Brisbane housing market peaked after recording a 42.7% boom in values. Over the past 2 months, the market has reversed sharply, with values down 1.8% and 0.8% for the month of July. In regional areas, the fall was almost as extreme, with a 1.5% drop in August. Now, the reactions in price declines are likely linked to the increases in interest rates. That is just one factor, and there's lots of factors that affect the property market, but the costs to landlords and owners of properties going up significantly is going to see decline in people's ability to borrow from the banks and to be able to hold their investment properties. So what we're seeing here is reduced serviceability on the buying side and increased holding costs for property investors. When you're looking and running the numbers on your property portfolio, when you're looking at the interest rates, you ideally want to have a 3% plus buffer when you're running your cash flows. So if you're expecting a 5% interest rate, at least run your interest rates at 8% on principal and interest to see how you would manage your cash flows if that scenario was to play out. These holding cost pressures plus the reduced serviceability is going to keep the lid on property prices, in my opinion, at this point in time. But as the market opens up and as people get comfortable with where the Reserve Bank is heading and everyone's on the same page in terms of sentiment around the property market and what's happening in terms of interest rates, that's where I can see the dip disappearing and another uptick in property prices occurring. Now, of course, this is all speculation, so this is me crystal ball gazing as to what might happen in the property market. But my opinion is, using Brisbane as an example, that when the RBA finally reaches their cap and decreases interest rates, people are then going to go, great, we're comfortable with what the RBA is now doing. We can see the horizon of interest rates might stay steady around this point, around say a 3% Reserve Bank rate and say 5.5% or 6% market rate for interest rates. And what this means is people might flood back into the property market. For me, you want to buy when people are fearful. So if you can see fear in the market and you can find the right deal that meets your needs and meets your requirements as an investment, I would look to take action on that opportunity. That's exactly what Emily and I have done. We've counter-cyclically invested. We bought the Baby Queenslander, our second investment property, at the very start of COVID. COVID had hit and spread throughout Australia in Feb 2020, and we bought the Baby Queenslander in around March, April 2020, a couple of months after the virus had spread and the closures had happened across Australia. The reason we were comfortable with that decision is because we were investing for the long term. We weren't worried about these small market fluctuations, and we were looking to hold over 10, 15, 20 years, and we knew that the area we were buying in was in long-term demand and had great fundamentals and drivers for growth, as well as the cash flow that we required at that point in time. So making that investment purchase when other people were fearful was the right decision for us. Let's jump back into the article. The largest falls in regional home values are emerging from the commutable lifestyle hubs where housing values have surged prior to the recent rate hikes. Over the past 3 months, values are down 8% across the Richmond Tweed area, 4.8% across the Southern Highlands, and 4.5% across Queensland's Sunshine Coast. I mean, this is to be expected. These areas have seen boom prices, so of course they're going to have a pullback. Now we're seeing higher costs and a higher cash rate. And this is what you can see on screen here. They're mapping out the cash rate from Feb 7th, 2018, all the way through to August 2nd, 2022. And in about 5 or 6 days from when I'm filming this video, in early September, we're expecting the cash rate to probably go up another 0.5% from the RBA and maybe another 0.5% in the next month after that. Despite the recent weakness, housing values across most regions remain well above pre-COVID levels. Home values in all capital cities and rest of state regions, besides Melbourne, remain 15% more above levels recorded in March 2020, implying most homeowners have a significant equity buffer before their home is likely to be worth less than what they paid. A 15% peak to trough decline would roughly take CoreLogic's combined capitals index back to March 2021 levels. And isn't that the truth of it? Even though we're seeing some small price pullbacks across the major capital cities and across these tree change markets, people have equity in their properties. You need to also make sure that you've got the cash flow buffers to deal with higher interest rates and cost of living and expenses in holding an investment property. But at the end of the day, if you've got value in your home and you're not in a negative equity position, you shouldn't be too worried about what's going on in the market. That's just my opinion at this point in time. So leave a comment down below. I'd love to hear from you in the comments. I reply to almost all the comments. So let's have a chat in the comments about what's going on in property prices and what's happening in both the cities and the major regional locations. If you're interested in taking your property investment knowledge to the next level, maybe check out my course, Invest with Purpose. You can head over to my website, click the links and find the course there. We're currently offering $1,500 off by using the code JUMPSTART. So if you want to jumpstart your journey and take your investing knowledge to the next level, jump over to my website and have a look at the course. Otherwise, drop a like on this video, subscribe to the channel down below, and click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.